Financial risk management strategies every investor should know. Financial risk management approaches should protect every type of asset, from your personal pocket money to an entire company's cash. Otherwise, unmanaged spending could spiral out of control. Hello everyone, and welcome to a brand new video on the channel. Today we are going to talk about financial risk management strategies every investor should know. Before we get started with the video, don't forget to smash the like button, share the video, and subscribe to the channel. Number 10. Identify the risks. Going into combat without knowing who your opponent is may seem contradictory. You must understand exactly what you're up against in order to choose your weapons correctly. Even if the assets you seek to preserve are personal or corporate, they are not immune to human error. This means that you must be honest with yourself in order for the first step to be effective. Your funds may be jeopardized because you occasionally succumb to goods that you do not require but only desire. Furthermore, you should be aware of different types of hazards: asset-backed credit, foreign investment liquidity, market, operational, and model risks are examples. There may also be external risks that you cannot control or forecast, such as cyber attacks or theft. For theft, make a list of the sources of your budget drain and be as honest as possible. Number 9. Measure the financial risks. To regain control of your risk management, you must quantify each liability on your list. Because these metrics are based exclusively on statistical models, you may want professional assistance or a set of advanced financial instruments to calculate the numbers. One of the most difficult tasks in your management plan is evaluating financial threats. However, it is critical for the health of your assets that this stage is handled properly. The outcome will allow you to make more educated judgments about your future spending. Number 8. Learn about investments. A complex financial risk management plan should also address the concept of investments. However, ignorance can masquerade as greed, and people are more inclined to fall for schemes that appear too good to be true. Even after registering for a Forex practice account, consumers might apply a risk management strategy to avoid significant losses. However, if you devote enough time to learning and comprehending the investment market, you will discover that it yields robust and lucrative results. As a result, you should begin reading reputable investment websites, books, and articles to become acquainted with all of the concepts that govern this world. Number 7. Turn to insurance policies. Nobody wants to think about worst-case scenarios, but they are an important part of a well-structured risk management plan. It's difficult to imagine how many ways your automobile could be damaged or how many theft crimes have occurred in your neighborhood, yet insurance has become a necessity in our culture. Even if you are in wonderful shape right now, you should think about getting health insurance. Unfortunately, many people cannot afford these. You should, however, conduct some research and attempt to sign up for at least a basic kind of insurance. Number 6. Build an emergency fund. Taking precautions is never a bad idea, regardless of whether or not your current financial situation is favorable. You have the option to decide how much of each month's profits should be placed in a savings account. These emergency reserves will eventually prove themselves to be a solution that saves your life in the face of some of the financial dangers that you may face in the future. Number 5. Review the financial ratings of your bank. As a result of the worldwide recession that began in 2008, people gained valuable knowledge. Even if you have the largest savings account on the face of the globe and your bank has low financial ratings, you still run the risk of having nothing in your pocket at the end of the day. As a consequence of this, you ought to incorporate the responsibility that comes with committing your wealth to a certain bank into the risk management plan that you have devised for yourself. In the blink of an eye, you could find yourself bankrupt if something goes wrong with your financial institution. Number 4. Invest in your skills. Because your job has a significant impact on your income, you should devote as much time and energy as you can to advancing your professional career. Nobody is indispensable in the modern workforce due to the high level of competition, and most employees are aware that there are others who can take their job if they become obsolete. Therefore, you shouldn't let yourself get too comfortable in your work environment and instead actively seek out new challenges to help you polish your professional talents. This will not only increase your chances of being recognized, but it will also help keep your mind alert. Number 3. Diversify your income sources. There is a possibility that the source of your money may experience a difficult financial time. On the other hand, the possibility of that occurring for a number of different sources of income at the same time is relatively low. At some point in the future, geopolitical events may bring about a change in the financial market due to a decline in demand. On the other hand, if you have a number of other ways to bring in money, it's possible that your finances won't take a substantial hit. Diversifying one's holdings in one's financial portfolio is one of the most effective methods for mitigating risk. It will have your back in the event that a risk actually materializes. There is a possibility that the unfavorable effects will be distributed uniformly across all of the many sources of income you have. But it is quite improbable that this will result in catastrophic outcomes. Number 2, reassess your risks frequently. The management of risks is dependent on a wide variety of outside factors. These outcomes are due to the fact that the rules of the market are subject to change, which, in turn, causes the risk's levels of severity to fluctuate correspondingly. As a consequence of this, before making a significant investment, you want to take into account the state of the economy on a worldwide scale. Because circumstances may have shifted since the time of your previous evaluation, an efficient plan for risk management will analyze obligations on an ongoing basis. Regardless of whether one intends to purchase a new home or start a new business, it is important to take into account the various external elements that have the potential to put the investment at risk. Number 1, do your due diligence. When you are in the presence of documents, you need to exercise extreme caution. Whenever you are forced to part with money that you have worked for, you owe it to yourself to be prudent and study the contracts and paperwork that concern the terms of your purchase. This is your responsibility. A thorough check of this nature could take a significant amount of time and possibly be inconvenient. On the other hand, doing so can protect you against a great many dangers that might have an effect on you in the long run. That's a wrap on the video. I hope you liked it. If you did, let me know by giving it a thumbs up and do not forget to subscribe. Thanks for watching. See you next time.